I just laid out that kind of tech state of play, if you will. Is technology, in your mind, a buy right now, given those losses?
Hey, Dom, to see the reset in valuation technology, specifically to your point, you look at a name like Amazon, look at Meta, I still call it Facebook, and you also talk about Apple. That type of repricing or that kneecapping that they have took in is really interesting because I think if you own them in the proper way, this is the time to own technology. What's the beacon? What's the guiding light in owning sectors? As you know, I'm a big believer in owning sectors revealing strength and staying away from sectors revealing weakness. But what's interesting about technology is it's the 10-year note. The 10-year note has been the beacon, the guiding light. And sure enough, the 10-year note went from 1.53% to start the year all the way up to 3.49%. It just kissed 3.5%. As we see it come back down, currently trading about 3.21. I think that allows investors to come back into this massive repricing like our friends at White Charts just laid out. So yes, I do like owning it, but the darling that we own in our Essential 40 portfolio is Palo Alto Networks. I think you have to be very specific and own subsectors of technology because you cannot walk away from technology, own it in a prudent, equal-weighted manner, but you will see this market, specifically in technology, heal as that 10-year note comes back down to 3%, potentially tucks under 3% this fall.
All right, so you're talking about Palo Alto Networks. Let's lay out. I mean, obviously, this is now an environment where there are dislocations, certain underperformers and outperformers within that broader technology trade. I think more broadly of things like cloud computing, cybersecurity, you brought up Palo Alto Networks, financial technology has been absolutely slaughtered from the highs that we've seen recently. So what is that trade? Is it semiconductors? Is it software? Is it cloud? Is it cyber? Is it fintech? There are ETFs to play all of those these days. So where do you pick that spot, Jeff?
Dom, I think you actually have to embrace this dislocation. We've seen a ton of volatility this year, to your point. We're looking at industrials. We are owning a little bit of technology, but look at some of the industrial names. You know, an American Airlines, a Boeing, have been absolutely cream crackered. We've seen names like Delta Airlines, American Airlines, finally have the ability to get some legs here. But what's interesting, it's all about earnings coming up. And I know we have earnings in a couple of weeks, but think about the next 7 trading days. And this process we're in right now, this is a bottoming process. This doesn't feel good, Dom. John Malloy did a great job of pointing out yesterday, after a big pop like we had yesterday of 2.5%, typically you see a little bit of the wind come out of that sail. And that's what we're seeing today. But this is a bottoming process. So I think you have to be really prudent. You have to allocate here. It's no time to be afraid. Talked to a lot of advisors inside my Sanctuary network, and they're really embracing this volatility. I know a lot of people are talking about a recession, but I don't see a recession. One of the most underappreciated components of this whole market, I know we're focused on Fed chairman today and tomorrow, all the rhetoric about rate hikes, but the most underappreciated component of this whole marketplace is that the Fed still has a $9 trillion balance sheet. The quantitative tightening that they're talking about by reducing their balance sheet, it would have been impactful if they would have reduced $47.5 billion back in 2005, 2006, when their balance sheet was only $460 billion. It would have been impactful, Dom, if they would have reduced $47.5 billion pre-pandemic, when their balance sheet was only $4.6 trillion. But now with a $9 trillion balance sheet, that is the safety net. So this bottoming process we're in, you have to lean into, you have to be sector specific. I also like 2 names in Oracle and Intel. I know they're down year to date, 21%, 27% respectively. But if you look at the energy sector, if you look at the industrials, if you look at the earnings expectations, the bar is so low, Dom. This is the time to wake up, smell the coffee, and start buying some of these really blue chip tangible names.